Morning, market chameleons. Happy Tuesday trading day. And we're waiting for the main chameleon, Dimitri Pargamatic. How you doing, Dima?
Good morning, Will. How are you?
Good. I've had the disclaimer up there. We want to go through it right away?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the
excellent.
disclaimer.
Yeah, before we get started, I have to say, did you know Facebook was going to shut down for 6 hours yesterday when you were giving your presentation in the morning?
Yeah, that's something I didn't know, but it'll be interesting.
Holy cow. Facebook was all over the news yesterday. Incredible.
Yeah, they didn't have a good day yesterday. And today could be, they have those hearings, right? So the whistleblowers, I think she's scheduled to testify today. So that might be all over the news too.
Yeah, no, it's been all over CNBC this morning. Facebook certainly is not in good light right now.
Yeah, they're going to have some challenging times ahead. So I think today, Will, what I'm going to do is talk about time spreads, calendar spreads, because I do get requests to create screeners for time spreads, calendar spreads, and I'm working on that. But there are certain tools right now that you can evaluate calendar spreads. And one of the things that I need to do before we bring out the calendar spreads is, I talk about sometimes how it's very hard sometimes for me to deconstruct these preconceived notions of how to trade at the calendar spread or how to look for calendar spread, right? And just like we talked about Edge a couple of days ago, and I got some good emails. People really appreciate it, and it's the mindset that people, sometimes people are watching videos on YouTube, right? And sometimes people are reading things, and then they get this impression how to do it. So I'm going to give examples to kind of break down, calendar spreads, the risks, rewards, and I think calendar spreads are very rewarding. One of my favorite strategies, but I need to kind of explain and walk you guys through it. So before I even push out the screener, right? And before we see, look, how do we find opportunities? I kind of have to go through it and walk you guys through it of a calendar spread. Okay. So that's what we'll discuss today. And if people have questions, put them in the chat. If you want to come on the show, ask your question live, we'll put in a link there. You could click on it. That will take you over to the what's called the
Zoom.
The Zoom, and you don't have to turn on your video, but we'll be able to hear your question. So those are two ways you could ask the question.
Yeah, and for those in YouTube, to click that Zoom link, the link is at the top of the chat. It was the first thing put in this morning. So just go to that link, click over, and raise your hand when you're on the Zoom, and we'll get you on board.
Right. All right. So let me share my screen real quick. We'll start out as usual, just take a quick peek what's going on in the pre-market hours. Then I'm going to move on to the discussion about calendar spreads. All right. So these are stocks right now trading in the pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I see here 131 stocks made our percentage gainers list, 32 on the percentage decliners list. So now we're looking at a more bullish bias at the open. I'm going to use the market cap filter just to see what's going on in the higher market cap stocks. So market cap 20 billion or higher. And I see 37 made the percentage gainers list, 1 on the percentage decliners list. So they're bullish bias at the open. The lists are not huge. We don't have hundreds of them, but overwhelmingly from this perspective, right now, we're looking at a higher opening. If no questions, I'm going to kind of move on to the calendar spread and talk about that.
Yep. Move over.
I'll probably use SPY as an example. And here's so when I get requests, for calendar spread, this is usually the request. And I just put it down in my notepad. And this is what people will screen for. They want to buy a calendar spread, right? So the perception is first that, I buy the calendar spread. So I'm buying, a longer term, right? Longer term option, selling the short term, and the perception is, well, because I own the longer term, there's less risk, because if the shorter term expires, I have the longer term option remaining, so I'm kind of hedged. Which, okay, there's some truth with it, but as long as you know how to manage your position, I think both are fine. The reverse is fine. We'll have to talk about that more, but let's take this first one. So you're buying the calendar spread, you're buying the outer month, selling the shorter month, and this is what people usually want to screen for. So automatically, and they're probably watching YouTube videos or reading this, and that's why, and this is why I have to discuss it. So this is what they want to screen for, that they're going to do it by implied volatility. And they're going to say, if implied volatility in the shorter month, right, near-term month, is higher than the longer-term month, and I'm giving you an example here, then this is when you buy it. And this is going to be the problem. This is not how you can, if you're doing it this way, you're going to be very disappointed, because if your perception is, well, then, I'm buying longer term at a lower implied volatility, then I'm selling at a higher implied volatility in the shorter term, and you're expecting that this is based on just that information alone, that this is a good spread, then you're going to be disappointed. And really, maybe if somebody's teaching you that, then you got to go there and ask them questions and say, well, okay, then show me examples of that. Show me examples. I want to see where you did that, where you you sold 25, you bought 18, show me the outcomes, because it's one thing to say that, but show me the data. Then go back to them and show me the data, because that's fundamentally wrong. That's how you're screening, okay? And it's because, I think people who think they understand implied volatility, if you think you understand implied volatility just because you listen to YouTube videos, then you probably don't understand it, okay? If that's where all your information's coming from, and I don't care which broker, and I've read these all the time from even, some of those most respected news agencies, some of the, the biggest firms, I watch them and I'm like, all right, then, maybe the person doesn't really understand implied or never derived it, because that's not exactly how it works. Because otherwise it would be pretty easy to scan for these, but if that's what you're basing it off, then you're going to be disappointed, because that's not exactly how it works. And really, it's very hard to do, something that a person is convinced it's supposed to work this way, it's very difficult to break that down, but this is one of the challenging things. Now, knowing this, all right, let's just say, for sake of argument, that this is not really what we should be scanning for, so then what should we be scanning for, right? And I'm going to show you some examples. I'll show you the data here. So a couple of things about time spreads, right? Here's SPY. And I'm going to just bring up this activity here. And when you're doing time spreads, the important things, it's not the implied vol. You have to convert these then to the premium. Okay, what's the difference in the premium? Not the implied vol, but the premium between the two expirations. And I'll give you an example here. Here, like say I go out to this expiration November, let's say November 3rd, so 22 trading days to go. So that straddle is 4.5% premium, right? So that's what I'm paying for that straddle. If I come out a little bit further, all right, here's 34 days, I'm paying 5.5% premium. So there's a 1% spread, okay? So I'm paying 1% more for 34 days versus 22 days. And remember implied volatility, that's not what it captures, right? That's not how implied vol works. If you read about implied volatility, if you know the model and understand it, and it's trying, it's this model that's based on a certain way that you trade options, and there's a lot of assumptions in there. It's not a formula. It's a model, right? It's a model that estimates something, and it's based on you trading a certain way, hedging your deltas, your gamma, and so forth. I'm not going to get into too much of that, but the Black-Scholes model is not very good at certain things. Okay, it's not for everything. So here, well, what is usually the spread, between something like this is really what we're more concerned about. Is 1%, is that narrower, is that wider than usual? Where is it relative to how it usually trades, and is it good enough? That's really the question, the scan that we want to know. Okay, and on top of that, when you do a spread, when you're doing a calendar spread, you also have a delta. So you have an outlook where the stock is going, right? So if you think that the stock is going to be around here, 430, you want to do your calendar spread on the 430 strikes. If you think there's a greater chance that it's going to float higher, let's say to 435, you want to do it on the 435 strikes. If you think if it has a greater chance of going down, let's say to 420, 425, you want to do it on those strikes. So you do have a directional bias as well, right? So the calendar spread, the way we set it up right now, selling the near term, buying the far term, that means that the closer it gets to those strikes, the better it is for you. Okay, so that's being long the time spread. And let me know if you have any questions. So let's go. There are a few different tools kind of to look at it. I'm going to go to the strategy benchmarks here. These are kind of just benchmarking, before that, not to do too many things, I'm going to go to the options chain. So on these options chain, right, I'm going to set up a calendar spread, and I'm going to kind of show you what I mean, right? Let's just look at the data. So let's say we use these 2 months, October 15th, right? And I'm going to just say October 15th, I'm selling the 430 strike. We'll just do that, the money, right? So this is our first leg, 9 days to go, October 15th. We're looking at the money, 430. I'm selling this call. And then I'm going to go out to November 19th, okay? Outer month, right? So this expires after 34 days to go. And I'm buying the same strike, 430. 1099. Okay, and this is how it looks. So we want the stock to be at 430, right? That's our sweet spot. That's where we gain the most. So before I go over well, is this a good deal? If it's not a good deal, first let's just take a look at the historicals here. So here's the historical premiums, how this looked. All right, and this is daily. Okay, we're capturing daily snapshots of the 430 strike. These are the implied volatilities end of day. This is the closing price. Okay, so you could see how the implied volatilities relative to each other are changing. And let's just go back in time, because now we have to kind of do a proof of my thesis, right? Is my thesis incorrect? Like that, hey, the best time to buy is when this is the November. Remember, this is November, the outer month. This is the October. This is the outer month, right? So I'm just going to go back in time, and I kind of see that the outer month, right? The implied volatility is always, so far it's always higher than the inner month, right? So October, implied volatility is over here. November, the correlating volatility is over here. So you could see here, On this day, November closed at 19 IV, October 18.8. So here the hours higher. And I kind of see that consistently, right? So let's just say that based on this information, we would have thought you shouldn't be buying this calendar spread, maybe selling it, right? Maybe then if you don't think it's a buy, maybe you think it's a sell, right? In that case, you buy this and sell this. So what if that worked out? So let's just say here, August 11th, right? Here, this is the value of it, $3.31. So this, the price of this call 23, the price of this call 19.7. So $3.31. But you said, well, I wouldn't do this because this implied vol is higher than this. So let's go see if it inverted and what happened, right? That means you would have preferably sold it right at 331. So let's see when these two inverted and this, right? This went above here. Everybody following me? Hopefully. So I'm going to kind of scroll up here. This one came closer, but let's see if it ever inverted where the front month went above. So remember, I started at 331, right? Assuming I didn't want to do this because this wouldn't have been in my scan. This, you would have thought this isn't good because of the implied loss, right? So I would have skipped that at $3.31. And let me go up and see where it inverted. So I'm just scanning. I'm hoping it does at some point. So here we go. This is inverted. So now this month, October, is above November. Look where this is, 483. So you actually not only would have missed an opportunity, right? What is that, like a 50% gain, whatever? Not only would you have missed an opportunity, but you potentially would have been going the other way if you're doing it based on an implied volatility scan. Do people see that, what I just showed you?
They do. Rob says this is a must watch. He just, it's so much information that it's hard to all grasp at once, but right. Very good.
And I'm showing because if I push it out and people, and I know it's, well, you're not, your scan is not correct. You need this implied. This is going to be the most challenging part for me, because then I got to go and say, okay, you got it. That's not how it works. Okay. So part of it is it's floating to the strike, right? It's floating to the 430 strike. So I don't remember where that August 11th was. All right. So that's part of it. It's floating to the strike. But the other part, it's not the implied volatilities. It's the relative premiums. Okay. That's the important part. It's the relative premiums that we have to compare, not the implied volatilities. So the relative premiums are dynamic with implied volatilities, right? And as the implied vols go higher, the relative premiums get closer. So you'll it takes time to like learn this. You're going to do it from experience. Sometimes that's one way to learn, is from experience. Say it's not working out the way I thought. What did I miss here? And some people will go back and try to learn. Other people just give up. But I'm trying to kind of set the framework even beforehand, right? That's not what we're looking for. It's not implied vols. It's the relative premiums that we kind of have to start looking at, and that means converting it, to the premiums. So let's take a look at. We're seeing the history. If there are no questions, I'm going to go kind of take a look at those relative premiums now.
All right, perfect.
So here's the IV theater. So this is comparing on each day. Each day, it's comparing how that IV close relative to each other and converting it to the premium. So theoretically, what should the premium be today? Based on historical premium. So it's actually doing it in reverse. It's saying I understand the IV, but I got to converted back into a premium, into a dollar. So it's doing a lot here in the background to kind of give you a theoretical value. All right. So a lot going on. These are reference prices, but it's basically converting it to a relative premium, percentage wise. So here, a couple things that are going on. It's looking at the last 4 years of data, right? And it's saying, okay, I know, we're looking at the 30 strikes. So I know how far away that is from the spot price. And I know how many trading days are left in each expiration. So what I need to know is, how did similar options with these parameters, right? So that's what I have to look at this moment in time. I don't know what's going to happen tomorrow or the day after, but at this moment in time, how did they trade versus each other on a relative basis, right? So that's the relative premiums in there. That's what we're looking at. And it's going a little bit further and saying that, I could use 4 years of data. I could change this to different number of years of data. And this is also looking at, because SPY doesn't have earnings, it's that we ignore that for now, right? Because earnings will be a different matter, but let's just stick with SPY. Another thing it does is say, based on where the implied vols are today, give me those snapshots. So that's the dynamic IV range. We could change it to all results. So let's just first see what this is giving us. So this is what it's saying, is that in the last 4 years, if we looked at a similar situation, where implied volatility was, near these levels, the distance, the distance of the strikes were similar to the distance from the spot price, the distance to the expirations were similar. Here's daily theoretical values based on those premiums. So we could kind of go back in time and see, the averages. So this is the average. If we took the average, its value is $6.28 versus $5.60 today. So you could see there that it's below the average. And then we could see the range as well. So we see it, it went way up here, as low as here. So this kind of gives us a relative value and a much better view of that time spread. Okay, because then we know, the range it's traded in and where it is relative to the range and where it is relative to the average. Okay, much better view than if you were just, because those implied vols almost tell you nothing. That's, you could use them, no problem. You guys could do it. And believe me, showing those implied vols the way I just described it right here, to scan for this, for me is much easier. It's much, creating this screen for me would be, we could do this in 5 minutes. This, what we're trying to work on, is months of work, of collecting data and validating stuff. So it's not like I'm trying to say, hey, I don't want to give it to you, because I can give it to you, no problem. You could scan it that way, and it's much easier for me. I just don't think I don't think it's going to give you this kind of valuable information. Okay. So we could also take a look at, we could change the number of years, to see, well, what about in the last year? So this is the range in the last year. We could see where it is versus the range and versus the average. We could also say, what, I don't care about, narrowing down the implied volatilities, just show me all results, which means, I don't care if the implied volatility was high, if it was low, whatever, show me all the results. We could reload that. Again, so here's the range, right? Here's the average. So now we see where we are priced today versus the average and versus the high-low range. Any guys have any questions about that? I know I went over a lot. It's a lot to break down, right? Because what I'm doing is saying it's not as simple as you're probably viewed. And not everybody, I mean, some people I think get it. Some people do trade that way, but not based on the feedback that I get from the emails and the chat, this is kind of, you have to go further than what you've probably seen, especially, when we're talking about around earnings and events and so forth. So,
hey, Dee, we did have a question from Trevor. He was asking, when doing this screen, where's the spot price?
So right now, SPY is like around 4. So this is based on yesterday's closing prices. We haven't opened up yet. So I used 430. SPY closed at 428.64 yesterday. So I just used the 430. And for this example, right? So I just used, just decided to use the closest one, or a close one to the spot price. So
Mike, we did have a question from Mike. Mike is asking, why not let us use what you have and then give feedback? I don't know what that necessarily is in reference.
So what with what I just showed you, okay, just what I showed you, there's a lot of more variables, when you say what we have and we're working on it, but it's much more intense, in the background, what we're doing than what you're usually, just the screener alone. And, we add a lot of screeners and a lot of, opportunities, but it's actually much more intense, than, and one thing we have to be careful is also the performance when some people start using it and capturing. Even right now, there's so much, it's so intense. We're only doing it for the top, I think, like maybe 250 of the busiest stocks. All right, even though you don't, you're seeing these two numbers kind of pop up, it doesn't look so much, but just to get there, it's there's a lot going on, just to get to these end values, right? So in the background, it's very big. So even that screener alone, is doing a lot of stuff, and we have performance, and then, and then I'm checking because there's like exceptions, or like, hey, what is this data point here? What happened here? They had a spin-off, or something. The exceptions are the things that really slow things down, because you're finding, out of 100 cases, 1%, what is this, what is that? So I'm still working through that as much as I can, and I can't even guarantee, there's no guarantee, right, with the data, because once we push it out, then people use it a different way, and then they report, exceptions here and there. And this will be part of not only the screener, but in January, we're planning to push out a centralized alert system. So this will be in the centralized alert system. So this is going to alert to calendar spread opportunities. So that this will be part of the centralized alert system that I think, my goal right now is to push that out around January.
Excellent.
So, yep.
Well, everyone on the chat is saying this is like a master's class. So
it's a little bit more to take in, especially the first time. And I'm going to try to, over time, start showing more examples. If you get used to calendar spreads, diagonals, even doing them, when to do them the other way, they're very, look, it's one of my favorite strategies, but there are lots of stuff going on. Then you have dividends, you have earnings, you have to go through all these different scenarios over time with experience. I think that when people use them, it's going to be very powerful. It's going to be great strategy and tools, because you'll know when to do it, when is the most opportune time, how to strategize around your outlook. But it takes experience and knowledge. Not everybody has that tolerance, right? To do it, to learn and experiment and get that experience. So but I'm going to try to do it more and more as we go along.
All right. We had a new user ask a question about a Volsky scan plus premium, and he's saying confirm. Thanks. I'm not exactly sure what is want. Email support. If you have questions, email support at MarketChameleon.com. I put that in the chat. That's available to anyone. D, great show, buddy.
All right. Well, thanks everyone for joining. Hope you guys stay safe out there. Hope you have a great trading day, and hope to see you guys tomorrow.